In this presentation, I'll talk about futures, markets, and contracts. The first point about futures contracts is that they are standardized. In a later slide, we'll talk about the similarities and differences between forward contracts and future contracts. But at a high level, one fundamental difference is that futures contracts are standardized. So, like forward contracts, however, in a futures contract on a given day, let's say on 1 January, you are agreeing with the counterparty that you will either buy or sell some underlying at a later date, let's say in July. Now, when we enter this contract, the underlying is clearly defined. So let's take an example of a cotton futures contract. What is the sort of information that is defined? Clearly the name of the underlying, in this case let's say that the underlying is cotton, so that needs to be specified. The type of settlement, either cash settlement or physical delivery. So for this futures contract we need to specify that at expiration of this contract, will we settle in cash, or is the short responsible for physically delivering the underlying? The contract also needs to specify what are the units of the underlying asset. So for example, we might say that the underlying is 50,000 pounds of cotton. We should specify what currency the price is quoted in. So we might say that the underlying price is quoted in dollars. We need to specify the grade or the quality of the underlying deliverable. We need to specify the delivery month. Obviously, if we have where the settlement is physical, then we need to specify when the underlying will be delivered. We need to specify the last trading day, so that's when the contract expires. Tick size refers to how much the price can change by. So for example, if the price is quoted in dollars, let's say it's quoted as 1.000, so we might say that the minimum price change is 1/100th of a cent. So if the price goes up, the smallest amount by which the price can go up is 1/100th of a cent, which is shown here. So a little more on futures contracts. In a futures contract, the clearinghouse holds the other side of each trade. Now again, this is best understood in contrast with a forward contract. In a forward contract, if you recall from our earlier lecture, we have two parties, A and B, and the forward contract is between those two parties. In a futures contract, the counterparty will always be a clearinghouse, or which is part of a exchange. So let's just call it the clearinghouse. So if you want to go long on one contract for cotton, then your counterparty will be the clearinghouse. The benefit of the counterparty being the clearinghouse is that this reduces or essentially eliminates any credit risk, because the clearinghouse puts certain rules in place that nobody will default. And the way the clearinghouse operates, it essentially sits in the middle. If you are here, you want to go long on one contract of cotton, so you will take the long position. The counterparty, which is the clearinghouse, essentially will take the short position, versus, let's say, so the clearinghouse can then take another position with another investor B. So with another investor B, now the investor B might take a short position, whereas for the transaction with investor B, the clearinghouse has a long position. So in this particular example, net the clearinghouse does not have exposure, but the benefit is that the clearinghouse puts rules in place where every investor basically can rest assured that there will be no default. A margin needs to be posted and marked to market daily. What this means is that, let's say you get into a long position on cotton, then when you enter this position, you need to post a certain amount of money. Details on how much money needs to be posted will be covered later, but you need to post some money which acts essentially as a performance guarantee. And if the price of the underlying goes up, then clearly you as the long benefit, and on a daily basis, if you are benefiting, then money is added to your account. So effectively, if the value of the contract goes up by $100, then $100 are added to your account. And since this is happening on a daily basis, we call this daily mark to market. So in a forward contract, if a forward contract is for 10 days, and every day, for example, so let's look at this case. Let's say in a forward contract you entered the contract with a contract price equal to 100, and let's say that at expiry the underlying is worth 110. Then the benefit of $10 you will realize at the end of the forward contract. Whereas if this were a futures contract and every day you benefit by $1, so bottom line is that at the end of 10 days again you will have benefited by $10, but in a futures contract every day $1 will be added. So at the end of day 1, your account essentially you will have had made $1. At the end of 2 days you will have made $2, and so on. So by adding to your account on a daily basis, effectively we can say that the transaction, or we can say that this we are marking to market. So by adding to your account on a daily basis, we are effectively marking to market. After 10 days again your overall benefit is 10. As with forward contracts, the terminology of long and short is the same. So long, if you are taking a long position, that means you are getting into a contract to buy the underlying asset. If you are getting into a short position, you are getting into a contract to sell the underlying asset. And if the underlying goes up, the long benefits. If the underlying goes down, then the short benefits. So let's now draw a distinction between forwards and futures, and from an exam perspective this is a popular question. So as you saw earlier, forwards are private contracts between two parties. So the one party could be a end user, the other party could be a dealer, but nevertheless these are private contracts. They are unique contracts in that you can define a forward contract for any underlying as long as both parties agree. So the contract can have terms and conditions that are agreed upon between A and B, the quality of the underlying deliverable, the delivery date, etc., etc. So as long as the two counterparties agree, you can define a forward contract for anything. There is default risk with forward contracts because you might make an agreement with counterparty B, but at expiry of the forward contract, counterparty B might not deliver. So there is default risk or credit risk. No margin. So when two private parties get into a contract, typically nothing is exchanged upfront. And there is little regulation. Again, since these contracts are between private parties, there is little or no regulation. Futures contracts. So again, the high level principle is the same, where in a futures contract you are getting into a contract to either buy or sell an underlying at a future point in time. But as mentioned earlier, these are exchange traded. So futures contracts are on an exchange. In Pakistan, we have something called the Pakistan Mercantile Exchange. Some of the largest exchanges in the world are in Chicago. So you have the Chicago Mercantile Exchange, the Chicago Board of Trade, the New York Board of Trade. So futures contracts are traded on an exchange, just the way stocks are traded on an exchange. Futures contracts are standardized. So if we talk about a cotton futures contract on the New York Board of Trade, then the contract will be very well defined. So as shown on an earlier slide, the quantity of the underlying, the delivery date, the quality, etc. will all be clearly defined. Futures contracts are guaranteed by the clearinghouse. So I've alluded to this earlier. When you take a long position in, say, a cotton contract, your counterparty is the clearinghouse. And since the counterparty is the clearinghouse, you can essentially be guaranteed that there will be no default. And how does the clearinghouse help guarantee that there are no defaults? The clearinghouse actually requires a margin. So whether you are long or short, when you get into a contract, you need to deposit some money in the account, and then this money is marked to market on a daily basis, as shown earlier, and more detail on this will come later. But if you are losing, so if you go long and the underlying starts going down, you need to keep depositing money in the account. So this way the clearinghouse helps ensure that there are no defaults. Obviously, since futures contracts are traded on an exchange, these contracts are regulated. Now let's look at an example of a cotton futures contract. So we have cotton futures contract on the New York Board of Trade. And let's say that we have July cotton futures contract which call for delivery of 50,000 pounds of cotton in July. So the underlying obviously is cotton. This is a deliverable contract, which means that the short is responsible for delivering the underlying, which is 50,000 pounds of cotton. So that is the further definition of the underlying, and these need to be delivered in July. The price typically for cotton is quoted on a per pound basis. So here I am very simplistically saying that the price is $1 per pound. If you actually look at the New York Board of Trade, the price is quoted in cents. So currently the price for a futures contract on 1 pound of cotton, or the price is approximately 95 cents for 1 pound of cotton. But nevertheless, just to keep things simple, I have a futures price of $1. So what this means is the following. So if we are here at time 0, let's say that it is currently October 2011, and let's say that this contract matures in July 2012. So when we have this contract price of $1, this means that at time 0, the long is willing to buy, or is not willing but is committing to buy 50,000 pounds of cotton at $1 per pound. Now that's the commitment. So the long is committing to buy at this price and this much, 50,000 pounds. Obviously, if the price of the underlying goes up, then the long benefits. Why? Because let's say the price goes up to $1.05. So when the price goes up, the long benefits, because the long has a commitment from the short that he will get cotton for $1 per pound. So if the underlying price goes up, so at maturity if the price is 1.05, clearly the long benefits, because in the market the price is 105 per pound. So just to hammer in the point, if we have this one contract for cotton, so worth 50,000 pounds, the long is obligated to buy 50,000 pounds in July at $1 per pound, and the short is obligated to sell 50,000 pounds in July at $1 per pound. Now, just to illustrate the mark-to-market point over here, let's say we get into this contract on October 25th, 2011. Then on October 26th, let's say the forward price has gone up to 1.01. So if the price has gone up by 1 cent, then on 26th October, the account of the long party will receive money. So in the next few slides we'll explain exactly how that's calculated, but on a daily basis, if the long party is benefiting, money is added to his account, and if the long party loses out on a given day because the price of the contract is going down, then money is taken out of his account. And obviously, since this is a zero-sum game, anything that benefits the long party will hurt the short party. So some terminology, and then this will be explained in detail through an example on the next slide. As alluded to earlier, when you enter into a futures contract, as in your position could be either long or short, you need to post what's called an initial margin. This is the money that you have to deposit into your trading account before any trade occurs. Maintenance margin is the margin that must be maintained in a futures contract. And if let's say that your initial margin is on a given contract $10, that means initially per contract you need to post $10. Maintenance margin might be $3, which means that if your account balance comes down to 3 because of losses, then you need to, so let's say your account balance comes down to $250, so it comes below the maintenance margin, then you need to add money to your account so you come back up to the $10 level. Variation margin is the funds that need to be added to restore the futures account to the initial margin. So the money that we need to add to come back to the initial margin, that's the variation margin. Settlement price is the average of trades during the closing period, and obviously we need to know the settlement price in order to calculate margin, as you will see on the next slide. Unlike the stock market where we normally see the closing price quoted in the newspapers, in the context of the futures market, the settlement price is quoted based on average of the last few trades in the closing period. And this might be because the very last trade might actually be some sort of an aberration, where if it's a very large amount, that might create an anomaly, or that might create a slightly higher or slightly lower price. So the convention used in the futures market is, we take at the end of the day, we take the last few trades, and the average of those last few trades is the settlement price. So now let's look at an example from the curriculum, and in the context of futures, I think this is probably the most likely exam question where you are tested on this concept. So make sure you understand this well. Let's say that we are talking about a contract on an underlying commodity called X, and the initial futures price is $100. So what this means is, let's say that you are here at time 0 and the contract expires here, let's say on day 90. When you get into this contract, the contract price or the initial price is equal to 100. So this is saying that if you are a long party, then for one contract you are going to have to pay $100 at expiry. So you will pay the $100 and you will get X at expiry. If we have an initial margin of 5, this means that on a per contract basis, to get into this trade, you need to post $5 per contract. Maintenance margin of 3, as described earlier, means that if your account comes below $3 per contract, then you need to add money to your account and come back to the initial margin. So let's now say that you are the holder of a long position on 10 contracts, and we are going to look over, let's say over a 6-day period, what will happen to your account. So day 0 means this is where you are starting. So on day 0, the beginning balance is 0. If you want to get into a long position on 10 contracts, you need to deposit $50. Why? Because we have a margin requirement of $5 per contract and we have 10 contracts, so you must deposit $50. The settlement price is 100. So this is where we started. This is given over here. So you can think of this as so this first line represents what's happening at the beginning of day 1, which effectively is day 0. Then what happens during the first day? This line over here represents the end of day 1. So at the end of day 1, so actually now this is day 1. So day 1, as shown above, the ending balance for 0 becomes the beginning balance for day 1, which is this point over here. Funds deposited 0. Now let's say that during day 1 the price came down to 99.20. So the settlement price at the end of day 1 is equal to 99.20. And recall from the earlier price, the settlement price of 99.20 was calculated based on the average of the last few trades on day 1. So that's the settlement price per contract. The price changed by 80 cents. So the contract price initially was 100. Now the contract price has gone down to 99.20. This means that at the beginning of day 2, anybody who gets into this forward contract, expiring again, let's say over here at the end of day 90, so people getting into a long contract over here would get into a contract price of 99.20. Now since the price went down by 80 cents or $0.8, the long party obviously has not done well, so there is a loss to the long party. On a per contract basis, the loss is 80 cents or $0.8. For 10 contracts, we multiply this by 10 and say that the total loss is 8, and the ending balance then becomes 42. So the beginning balance of 50 minus the loss of 8 gives you a ending balance of 42. So you start day 2 then with a balance of 42. You are still above the maintenance margin of $3 per contract. For your position on 10 contracts, you can think of your maintenance requirement as being $30. You are still above $30, so you don't need to deposit any funds. Let's say that on day 2 the price goes down further. So based on the last few trades on day 2, let's say the settlement price is 96. So in going from 99.2 to 96, there is a loss per contract of 3.2. On 10 contracts, the loss is 32. So your balance at the end of the day now is 10. So from a balance at the beginning of the day 42, you lose 32, and now your balance at the end of day 2 is 10. So this obviously is below the maintenance margin. So the maintenance margin, remember, is 30. Since your balance now beginning of day 3 is below the maintenance margin, you need to add some money. How much must you add? You must add $40 so that you come back up to the initial margin of 50. So for a 10 contract position, your margin needs to, the money in your account needs to come back up to 50. So you add $40 and you are up to 50. Then at the end of day 3, the settlement price is 101. Finally, you have made some money. Now you made $1 per contract. So the price change here is is 5. So what's happening here? From 96 we went up to 101. Price change per contract is 5. The gain on 10 contracts is 50. So your ending balance is 100. Now I think you can do the rest. You have seen a situation of what happens when there is a loss. You have seen what happens when we go under the initial margin but above the maintenance margin, so nothing happens there. You see what happened when we went under the maintenance margin, and you also then saw what happens when there is a gain. So the rest of the stuff you should be able to work out. These numbers have been taken from the curriculum, so you can also follow from there. And note the mark to market that's happening over here. Mark to market simply means that when you are making losses on a daily basis, your account is being adjusted to reflect the losses, and similarly when you are making gains on a daily basis your account is being updated to reflect the gains. So when you are gaining, you don't need to do anything. Money just pops up in your account. Why does it pop up? Because the exchange or the clearinghouse is putting money into your account. And when you are losing, then obviously you need to put money into the account, else your account will be frozen. And through this mechanism, the exchange helps ensure that there are no defaults. The next slide simply shows what happens to somebody who has taken a short position on say 10 contracts of the same underlying. And I'll not go over these numbers, I want you to do that, but basically it is exactly the opposite of what we just talked about. So when somebody has taken a short position, any reduction in price, so when prices go down, the short position actually is benefiting. So notice that on the earlier slide we initially had the ending balance going down for the long, but in the case of the short, the ending balance is going up because the short benefits when the prices are going down. However, when prices start going up, then the short is suffering because prices going up is bad for the short position. Now, hopefully you have caught this, but just in case you did not, I want to highlight the difference in the way margin is treated in the securities market or the stock market versus the futures market. If you recall from your lectures on equity markets and when we talked about margin, let's say we had a situation where you bought a stock for $25 and let's say that your initial margin requirement was equal to let's say 50% and your maintenance margin was equal to 25%. Then what did this mean? This meant that to buy your stock initially, if you are going with an initial margin of 50%, that means to buy this $25 stock, you put in $12.50 of your money and you can borrow $12.50. And if the stock price fell down, suddenly let's say the stock price went down to $10, so the stock price plummeted, then the margin, you will get a margin call, and I'm not going to go over calculations on how to come up with the call price. I assume you either remember how to do that or you can listen to the equity lecture again. But clearly when the price goes down a lot, you will receive a margin call, and when you receive a margin call, you need to put money back into your account. So the amount of money that you put back into the account brings you back up to the maintenance margin level. So you need to have an equity of at least 25%. So the core point here is when you add money after receiving a margin call, you need to come back up to 25% ownership. So essentially you need to come back up to the maintenance margin. As you just saw in the futures market example, we had an initial margin of $10, or actually we had an initial margin of $5 and a maintenance margin of $3. So when we fell below the maintenance margin, we had to add money in our account to come back up to the initial margin. So that is the critical point or the critical difference between securities markets and futures markets in the context of margin, that in the futures markets you need to add money so you come back up to the initial margin. So you might wonder, why then do we need the maintenance margin? We still need this maintenance margin because this is the amount of money. If your balance comes below this, then you go back up. So if you are somewhere in between, so if your balance comes to $4, then you don't need to do anything. So your money or your balance can remain at 4. It's only if, let's say, your balance comes below 3 that you need to top up, and you top up back to the initial margin. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire Level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both Level 1 and Level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.